Have you ever wanted to cut through the noise and truly understand the biggest global risks before they fully unfold? To grasp what a major geopolitical flashpoint could mean for your daily life, your investments, the global economy, without getting lost in all that information overload?
That's exactly our mission today. We're embarking on a deep dive into what the latest analysis identifies as, well, the single most significant geopolitical tail risk to global markets in 2025.
Hmm.
We're talking about a potential direct military conflict between Israel and Iran, centered specifically on Iran's nuclear program.
Right. So our goal here is to break down the anatomy of this escalating conflict, maybe quantify some of its potential market shocks, and explore actionable strategies for navigating the kind of volatility that would, well, surely follow.
Exactly. And critically, we're going to zero in on the primary way this risk transmits through the global economy, which is a potential disruption to energy trade through the Strait of Hormuz.
Yeah.
We're pulling back the curtain on this, armed with insights from a powerhouse report called Hormuz Under Siege, the 2025 Iran-Israel Conflict and Global Markets. It offers a really detailed, multi-domain assessment.
Okay, let's unpack this then. Our analysis suggests, as you said, that a direct military conflict between Israel and Iran is the single most significant tail risk for global markets in 2025. That's a pretty strong claim. Can you explain why this particular conflict is singled out as, so critical for all of us?
It's a valid question, and the tail risk distinction is really key here. It implies, a low probability event, but with an extremely high impact. What makes this conflict unique in that category is its direct and profound link to global energy supply.
Okay.
We're talking about its potential to disrupt approximately 20 million barrels per day of oil.
20 million? Wow.
Yeah, and a fifth of global liquefied natural gas, or LNG, trade via the Strait of Hormuz. So for you listening, this isn't just abstract geopolitics. This is about what the report calls a severe stagflationary shock.
Stagflationary shock.
Great. Imagine a painful combination. A sharp, sustained oil price spike, rising global inflation that eats into your purchasing power, and a contraction in global economic activity that could affect jobs, consumer spending, everything, really.
So to help us frame how we might manage this risk, the analysis outlines three core scenarios, each with a probability attached. First, there's a contained escalation that's given a 40% probability, suggesting what? Limited transient market impact.
That's right, limited short-lived effects.
Then, a protracted proxy war with a 45% probability, that sounds worse, sustained market stress, shallow global recession, persistent shipping disruptions.
Exactly, more drawn out, more damaging.
And finally, the worst case, full-scale conflict and Hormuz closure. Only a 15% probability, thankfully, but it would trigger a severe global recession.
That's the nightmare scenario.
Yeah.
And in financial markets, any of these, particularly the more severe ones, would trigger what's known as a risk-off rotation.
Risk-off rotation.
Yeah, this is where investors pull capital from more speculative or cyclical assets, those tied closely to economic growth, and move it into traditional safe havens. Understanding this rotation is really key to the actionable investment strategies we'll discuss later on.
Right. And here's where it gets, I think, really interesting. To truly grasp the potential scale of a 2025 energy crisis, our sources urge us to look back to the 1973 oil embargo. Now, for many of our listeners, that's almost ancient history. What are the key lessons from that period that are truly starkly relevant today, maybe even more concerning?
That's exactly the tension the report explores. You see, the 1973 crisis was set off by the Yom Kippur War. Arab oil-producing countries imposed an oil embargo on the U.S. and its allies. The immediate impact.
Catastrophic.
Catastrophic how? Crude oil prices saw a staggering four-fold increase in just months.
4 times.
Yes. This led to severe fuel shortages, rampant inflation, and a deep, protracted stock market crash. The Dow Jones Industrial Average lost over 45% of its value.
45%.
Ultimately, it was a watershed moment. It prompted the creation of the International Energy Agency, the IEA, and National Strategic Petroleum Reserves, SPRs, as buffers. But the real lesson isn't just about the price increase itself, it's the type of crisis it represents. A supply-driven shock, not a demand boom.
Okay, a supply shock. But this report really stresses something crucial. The 2025 scenario isn't playing out in a vacuum. It's a wildly different environment compared to 5 decades ago. What are the crucial variables that truly set today apart from 1973?
Well, there are several key distinctions. First, the monetary environment. In '73, we saw the collapse of Bretton Woods, a devalued U.S. dollar which just poured fuel on the inflation fire.
Right.
In 2025, we're in a period of coordinated global monetary tightening. Central banks are actively fighting inflation, and we have a relatively strong U.S. dollar. Now, all this could alter the inflationary feedback loop somewhat. A massive supply shock would still be overwhelmingly inflationary. Let's be clear on that.
Okay, so monetary policy is different. What else?
Second, the global oil market structure has evolved quite a bit. In the 70s, OPEC dominated, and the U.S. was heavily import-dependent. Today, the U.S. is a major crude oil producer itself, and non-OPEC plus supply is significant.
So that sounds like good news. More diversified.
It is, but there's a catch. A crucial vulnerability remains. Most of the world's spare production capacity, the oil that can be quickly brought online in an emergency, about 5 million barrels per day, is concentrated in Saudi Arabia and the UAE. And their response, given their intense rivalry with Iran, would be absolutely pivotal.
Right, they're neighbors. Okay, third difference.
Third, strategic buffers. These exist today and didn't in '73. IEA members, China, India, they now maintain significant government-controlled reserves. India, for example, holds storage equivalent to about 74 days of its consumption requirements.
74 days, that sounds like a decent cushion.
It can mitigate initial price spikes, yes, it buys time, but these reserves are finite. The report is very clear. They are wholly insufficient for a prolonged, large-scale Hormuz outage.
Wholly insufficient. Okay. So if higher energy prices hit the economy, what does this all mean for central banks? For their ability to, manage things?
Well, the 1973 crisis provides what the report calls the definitive historical blueprint for stagflation.
Stagflation. Stagnant growth, high inflation.
Exactly. Higher energy prices act like a direct tax on consumers, reducing their spending. And they're a critical cost for businesses, squeezing their margins. This dual impact slows growth while feeding inflation. It creates a poisonous policy trade-off for central banks.
Poise is how?
If they tighten monetary policy to curb inflation, they risk deepening the recession. But if they ease policy to support growth, they risk fueling even more inflation.
Damned if they do.
Precisely. And given their current hawkish mandates to control inflation, central banks like the Fed and the ECB would likely maintain high interest rates. And that would exacerbate the economic downturn, ensuring a painful period of stagflation.
Okay, so that's the grim economic backdrop. Let's turn to the trigger. How does this long-simmering shadow war between Iran and Israel actually explode into a full-blown crisis, according to the timeline presented in the analysis?
The crucial turning point is pinpointed to June 13, 2025. After months of escalating proxy skirmishes, Israel launches Operation Rising Lion. This involves large-scale direct military strikes on Iran's nuclear and military infrastructure.
Direct strikes? Like where?
We're talking sites like the Natanz enrichment facility, the Kondab heavy water reactor, military command centers in Tehran itself. This marks a qualitative shift from previous covert operations to overt military confrontation, a major escalation.
And Iran's response to such a direct, large-scale attack, it can't just sit back.
No, it's swift and severe. On June 14th, according to this scenario, barrages of ballistic missiles and drones hit Israeli population centers, Tel Aviv, Ramat Gan, causing dozens of civilian casualties.
Civilian casualties.
Yes. And attacks also target strategic infrastructure. One missile causes a significant fire near the Bizan oil refinery in Haifa. The conflict then quickly settles into a dangerous tit-for-tat cycle. Israel expands its targets to Iran's energy industry, security forces. Iran deploys more advanced missiles like the Khorramshahr 4.
And the U.S., where does Washington stand in this?
This direct exchange prompts an immediate international reaction. The United States publicly states it had nothing to do with the attack, but signals its preparedness. It disperses military aircraft from key regional bases like Al Udeid in Qatar.
Okay.
Then President Donald Trump announces that a decision on direct U.S. intervention will be made within 2 weeks. That just creates profound market uncertainty. Everyone holds their breath.
Right. So the initial punches have been thrown. The U.S. is weighing its options. The world's watching. But this isn't just about two nations, is it? It's about a complex web of regional players, each with their own agenda. Who are the critical actors shaping this conflict's trajectory, and what are their, nuanced roles?
Absolutely crucial point. Take Hezbollah, for instance. Historically, they'd be Iran's most potent proxy, right?
Yeah, definitely.
But the report indicates they enter 2025 in a significantly degraded state.
Degraded how?
A devastating war with Israel in late 2024, including the assassination of its leader, Hassan Nasrallah, that decimated its command structure and much of its missile arsenal. Plus, the fall of the Assad regime in Syria severed crucial weapons supply routes.
Ah, okay.
So Hezbollah's leadership has indicated they will await Iran's orders, and there's strong domestic pressure in Lebanon against being dragged into another war. Now, this weakening, ironically, removes a crucial, maybe more calibrated response option for Iran.
Oh, so.
It pushes them toward more binary and extreme actions, like directly targeting global economic vulnerabilities, like Hormuz. It significantly increases the probability of strategic miscalculation.
So Hezbollah being weaker might actually make things more dangerous globally.
Wow. Okay, what about the Houthis in Yemen? They've already proven to be a Red Sea wildcard, haven't they?
Hmm.
They have. In stark contrast to Hezbollah, Yemen's Houthi movement emerges as a key player. Despite a U.S.-brokered ceasefire in May 2025, which notably doesn't apply to Israel, they've proven their capability. They can disrupt Red Sea shipping, and they can launch long-range missiles directly at Israel. Remember the May 2025 strike reportedly near Ben Gurion Airport?
I do. So they open up the second front.
Effectively, yes.
Yeah.
A second maritime front for Iran, directly impacting global trade.
Yeah.
And further, you have threats from allied Iraqi militias. They've threatened to close both Hormuz and the Bab al-Mandab Strait if the U.S. intervenes. That underscores this multi-front maritime risk.
And the Gulf states.
Saudi Arabia, the UAE, they're right there.
They are caught in what the report calls a precarious neutrality. Geographically, economically, they're incredibly vulnerable.
Right.
Publicly, they condemn Israel's strikes, call for de-escalation, but privately, they likely welcome actions that weaken their regional rival Iran, all while still relying heavily on the U.S. security umbrella. It's a very delicate balancing act. And fraught with risk. Conflict spillover could easily target their own critical energy infrastructure or the American bases they host.
Exactly. Which brings us right back to the Strait of Hormuz. The report emphasizes this as the world's most critical and irreplaceable energy choke point. Can you help us visualize just how crucial it is? Paint a picture. It's vital because of the sheer volume passing through such a narrow channel. In early 2025, we're talking approximately 20 million barrels per day of oil and refined products.
20 million a day.
That's roughly 20% of total global petroleum consumption. More than a quarter of all global seaborne oil trade. It's the primary export route for Saudi Arabia, the UAE, Kuwait, Iraq, Iran itself.
It's not just oil, right?
Not at all. It's equally critical for liquefied natural gas, LNG. About a fifth, maybe even a quarter, of global LNG trade passes through it annually, mostly from Qatar.
And where's all this energy going?
The overwhelming majority, about 84% of the oil, 83% of the LNG, is destined for Asia. That makes China, India, Japan, South Korea acutely vulnerable.
Acutely vulnerable. Okay, so you might be thinking surely there are alternative routes, pipelines, something to handle all that flow if Hormuz is disrupted.
You'd hope so.
Yeah.
But the report is clear. These alternatives are critically limited.
Critically limited. Explain that.
Well, the primary alternatives are Saudi Arabia's East-West pipeline running across the peninsula to the Red Sea and the UAE's Abu Dhabi crude oil pipeline, ADCOP, which bypasses Hormuz to the Gulf of Oman.
Okay, so pipelines exist.
They do, but here's the kicker. While these pipelines have a combined nameplate capacity of nearly 7 million barrels per day, their available spare capacity, what could actually be brought online quickly in an emergency, is estimated by the EIA at a mere 2.6 million barrels per day.
Only 2.6 million out of the 20 million going through Hormuz.
Exactly. Iran's own bypass pipeline, Gorjask, is negligible in the grand scheme. The stark reality is a full closure of Hormuz would strand over 17 million barrels per day of oil and virtually all of Qatar's LNG exports. There's simply no viable alternative route to market for that kind of volume.
Wow. Okay. Now, what's fascinating here, and maybe more worrying, is that the report highlights something called a soft closure. It suggests this is a far more plausible and maybe more dangerous threat than a full military blockade. What exactly does that mean? How might Iran leverage the strait? It sounds almost like geopolitical judo, weaponizing insurance and fear instead of just brute force.
That's a great way to put it. Iran's strategic calculus, according to the analysis, is that a full military closure, mines, blockades, sinking ships, is high risk, probably low probability. It would invite a massive response from the U.S. Fifth Fleet.
Right. It guarantees direct conflict with the U.S.
Exactly. But a soft closure can achieve a similar disruptive effect by making the strait prohibitively dangerous and uninsurable through asymmetric means, less direct confrontation.
Asymmetric means like what?
Things like targeted but sporadic attacks on tankers using drones or those fast attack craft they have. Laying sea mines, maybe just a few, in narrow channels. Widespread GPS spoofing, electronic interference to mess with navigation.
So it's not about, tanks and missiles physically closing the strait. It's about making it economically impossible for ships to even risk going in.
Precisely. Creating uncertainty and fear.
That sounds truly insidious, a self-fulfilling crisis.
That's the term the report uses.
Yeah. Yep.
Effectively creating a self-fulfilling supply crisis.
Yeah.
What happens? Maritime insurance premiums, especially for war risk coverage, would skyrocket. Major tanker operators like Frontline, which reportedly suspended new contracts in the initial phase of the 2025 conflict scenario, and their underwriters would declare exclusion zones. Or they charge premiums so high they render voyages completely uneconomical.
So ship owners just wouldn't send their ships there.
Exactly, they'd refuse passage. This gives Tehran plausible deniability. It's not us, it's the insurance markets, while effectively weaponizing the global economy.
Okay, let's connect this back to the bigger picture. If this soft closure or even a full closure happens, what are the price forecasts for oil under these increasingly severe scenarios?
The forecasts, as you'd expect, vary dramatically with the severity. In a limited disruption scenario, maybe just heightened tensions, a few incidents, oil prices are forecast to rise into the, say, 90-day, $95 per barrel range. Manageable, maybe.
Okay, but the worst scenarios.
In the event of a full closure or a broader regional war, the forecasts become dire. Some estimates see oil surging to $120, $130 per barrel. Others suggest prices soaring above $150 per barrel.
$150 plus?
Yes, potentially even more severe than the shock we saw after Russia's invasion of Ukraine in 2022. And such a price level would almost certainly trigger a deep global recession.
A deep global recession. Okay. When you look at these potential market impacts, beyond just oil prices, what stands out to you about how global equities and traditional safe havens would likely react?
Well, for equities, the impact is unequivocally negative. There's just no sugarcoating it.
History tells us that.
It does. The historical precedent from 1973-74 saw the Dow Jones lose 45% of its value. And even the initial reaction to the 2025 Israeli strikes in this scenario, just the prelude, saw the S&P 500 fall nearly 2%, international developed markets almost 4%. A protracted conflict, one of those higher probability scenarios, would almost certainly trigger a deep bear market. The S&P 500 is projected to fall anywhere from 20% to potentially over 35%.
And emerging markets.
MSCI emerging markets would likely underperform significantly. They face that triple whammy: reliance on energy imports, capital flight as investors seek safety, and the impact of a strong U.S. dollar.
Okay, equities down. What goes up? Gold.
Gold.
Yes.
It's highlighted as the primary beneficiary, the ultimate safe haven asset.
Why gold specifically?
It's seen as a hedge against geopolitical risk, against stagflation, against currency debasement. Plus, there's already a strong underlying bid from central banks buying gold reserves. The forecasts here are pretty bullish. Major institutions see gold reaching $3,100, $3,500 an ounce, some even suggesting $4,000 an ounce by early 2026 in a severe scenario. A war would be a powerful catalyst.
$4,000 gold. Wow. What about digital assets? Bitcoin, crypto, how do they fit in?
They present, as the report puts it, a tale of two roles.
Two rules.
Initially, you'd expect a sharp sell-off. Cryptocurrencies tend to behave like high beta risk assets.
Meaning they move more dramatically than the overall market.
Exactly. They amplify market movements. So when the broader market drops on risk aversion, crypto often dropped even more sharply. The initial news of the conflict in this 2025 scenario reportedly triggered over $1.13 billion in liquidations. Bitcoin fell sharply.
Okay, so down first, what's the second rule?
For individuals in conflict zones, or perhaps those facing sanctions, decentralized cryptocurrencies can function as a tool for capital flight, getting money out when traditional systems fail. This could lead to a V-shaped recovery in price later on.
Interesting.
But it's important to note the analysis still characterizes crypto primarily as a speculative tool, not a reliable institutional-grade safe haven like gold. The volatility is just too high for that comparison.
Got it. Now, this raises an important question about inflation. We talked about the stagflation risk. Our analysis highlights an asymmetric nature to the inflationary shock. What does that mean for the prices we see day to day?
It means the price surge wouldn't be evenly distributed. It would hit diesel and jet fuel hardest.
Diesel and jet fuel, why them specifically?
Because these aren't just things consumers buy directly at the pump, although some do. They are fundamental inputs for the entire global logistics and supply chain network.
Ah, the things that move everything else.
Exactly. They power the ships, the trucks, the planes that move goods worldwide. So even if governments use their strategic petroleum reserves, their SPRs, to try and manage gasoline prices for consumers, the cost push inflation embedded in the price of every single transported good would be severe and persistent. It directly impacts core inflation, the underlying trend.
Which makes it harder for central banks.
Exceptionally difficult. It makes it much harder for policymakers to pivot to an easing stance, to cut interest rates, because core inflation remains stubbornly high. This prolongs the economic pain.
Okay, let's shift focus slightly. We've talked global impacts, but how would different nations cope with this? Beyond the averages, who is most vulnerable, and what, if anything, have they done to prepare?
The report clearly identifies the epicenter of vulnerability as Asia. No question.
Nisha. Okay, like who?
India, for instance. Its crude oil import dependency hit a record 90% in April 2025, according to the data used. A Hormuz closure could directly impact 40% of its crude imports and a staggering 54% of its LNG supplies. That's acute exposure.
What are they doing about it? Any countermeasures?
They have several. Supplier diversification looking more to places like West Africa. A major domestic push into biofuels, with ethanol blending targeted to reach nearly 20% in 2025. Ambitious missions for green hydrogen, critical minerals. And in the short term, as we mentioned, that strategic storage provides a buffer equivalent to about 74 days of consumption.
Okay. China, world's biggest energy importer.
Also highly sensitive, naturally. Their approach is described as a dual-track strategy under their 2025 energy law, meaning they aggressively promote renewables, huge investments, $625 billion allocated in 2024 alone, while also reaffirming coal as a reliable backstop, even funding new coal generation. China would also leverage its substantial SPR, its diplomatic ties with producers like Russia, and ramp up domestic coal production. Still, a prolonged outage from the Gulf would be a severe economic blow, no doubt.
And Japan. Energy poor, very import reliant.
Extremely reliant. They've undertaken what the report calls a significant nuclear pivot. Their latest strategic energy plan, approved February 2025, abandons some post-Fukushima caution. It targets a substantial portion, maybe 20% of its electricity from nuclear power by 2040.
That's long term. What about immediately?
In the immediate term, a crisis would force Japan into desperate competition for scarce and exorbitantly priced spot LNG cargoes from places like the Atlantic Basin, Australia, while drawing down its own strategic reserves. It'd be a very tough situation. But perhaps the most dangerous second-order effect, beyond the initial shock, is what the report terms the frantic, zero-sum scramble for any available energy supplies outside the Persian Gulf.
Scramble crisis.
Think about it. More than 17 million barrels per day of oil, maybe 20% of global LNG trade, suddenly trapped. It has to be replaced somehow from somewhere else. This would pit the major Asian importers, China, India, Japan, South Korea, against each other and against European buyers too, in a fierce bidding war for non-Gulf cargoes.
Driving prices even higher.
To astronomical premiums, as the report puts it. WTI crude, U.S. LNG exports. Prices would skyrocket. This creates immense political friction, potentially straining long-standing alliances. It could even lead to export restrictions and a breakdown of international energy cooperation as countries hoard supplies. This secondary scramble crisis could be as economically damaging as the initial supply shock itself.
A crisis layered on top of a crisis.
Yeah.
Okay, so we've walked through the anatomy of this potential conflict, the regional players, Hormuz choke point, the global impacts. Let's quickly reiterate the importance of those probability-weighted outcomes and the detailed scenario forecasts. Scenario 1. Contained escalation, 40% chance. Brent oil, $85–95. Global GDP impact, minus more 0.2%. S&P 500 down 5–10%, but recovers. Manageable.
Right.
Scenario 2, protracted proxy war and shipping disruption, 45% chance. Brent, $100, $130. Global GDP minus 1.5%, a stagflationary recession. S&P 500 down 20–25%, a clear bear market.
Much worse.
And scenario 3. Full-scale conflict and Hormuz closure, only 15% chance, but Brent, $150++. Global GDP down 3.0%, a severe global recession. S&P 500 down 35% or more, a market crash.
The worst case, yes.
Okay, so given these potential outcomes and the stagflationary threat looming particularly in scenarios 2 and 3, the report details an actionable investment strategy focused on defensive positioning. So what's the armor against this? What does that look like for our listener who wants to try and navigate this volatility?
Right. The recommended portfolio shift involves thinking in terms of two thematic baskets. First, what they call the geopolitical risk basket. These are positions you'd want to be long.
Long meaning you own them, expecting them to go up.
Exactly. This includes energy itself, especially upstream exploration and production companies, E&Ps. Why? Because they benefit directly from rising oil prices, particularly those with unhedged spot price exposure and low production costs. Or for diversification, ETFs like the Energy Select Sector SPDR Fund, ticker XLE. Historical data shows energy can deliver positive real returns during stagflation.
Okay, long energy. What else in this basket?
Defense sector stocks. Companies like Raytheon, RTX, Northrop Grumman, NOC, maybe Palantir. PLTR. They benefit from increased military expenditures on things like missile defense, drones, cybersecurity, surveillance, all things in demand in this scenario.
Makes sense.
And perhaps surprisingly, certain segments of marine shipping, specifically the giant crude oil tankers, VLCCs, Suezmax types, the supertankers.
Why them? Wouldn't shipping be disrupted?
Yes, through Hormuz. But tankers operating on non-Persian Gulf routes, particularly those going the long way around Africa, like from the Atlantic Basin to Asia via the Cape of Good Hope, would see soaring day rates because the voyages are much longer, tying up capacity.
Scarcity pricing for the ships on the safe routes. Okay, so that's a long basket. What about the other side? The cyclical downturn basket. These are shorts.
Yes, positions you'd potentially bet against, expecting them to fall. This includes airlines and travel. They're acutely vulnerable, skyrocketing jet fuel prices, plus decimated demand from recession fears and security concerns. It's a terrible combination for them.
Right.
Also, automotive and retail sectors. Highly cyclical industries that suffer badly when high energy prices act like a tax, reducing consumer discretionary income. People cut back on big-ticket items and non-essentials first.
Okay.
And emerging markets, with the important caveat of excluding the major commodity exporters who might benefit from higher prices. Other EMs face that triple threat we mentioned: higher energy import bills, a stronger U.S. dollar making their debt more expensive, and capital flight.
Got it. Long energy defense shipping, short airline SATO CMs.
Hmm.
What about broader asset classes for hedging?
A multi-asset approach is key here. For commodities, a core long position in gold is recommended as the primary hedge. Physical gold, futures, ETFs like GLD, and for direct exposure to the oil price spike itself, long crude oil futures or perhaps call options.
Okay, currencies.
Currencies. A long position in the U.S. dollar is seen as critical. It benefits from a flight to safety and liquidity in global crises. You could express this by going long the DXY dollar index or by shorting vulnerable currencies like the Japanese yen, JPY, the euro, EUR, or the South Korean won, KRW.
Right, dollar strength. Equities beyond those baskets.
For equities, beyond the specific sector bets, the strategy suggests rotating into defensive sector ETFs, things like utilities, XLU, and healthcare, XLV, which tend to hold up better in downturns. And for direct hedging against market falls, consider shorting broad market indices like the S&P 500 via SPY or the MSCI Emerging Markets Index via EEM.
And finally, fixed income bonds.
Fixed income is tricky, complex. You might see an initial safe haven bid for U.S. Treasuries, a flight to quality, pushing yields down briefly.
Right.
But persistent inflation makes long-duration bonds very risky in this environment.
Right.
Rising inflation erodes the value of fixed payments far out in the future. So the preferred strategy here is actually cash-equivalent assets.
Like T-bills.
Exactly, short-duration T-bills.
Yeah.
Keep your powder dry, maintain liquidity.
Okay, so wrapping this up, the crucial lesson from this deep dive, and really from historical oil shocks like 1973, seems to be that the nature of the shock dictates the strategy. A demand-driven boom is one thing. It supports broad markets. But a supply-driven shock, like the one we've been discussing, is fundamentally recessionary. It requires, as the report says, a completely different playbook.
That's absolutely right. The 1970s already showed us that in a stagflationary environment, that nasty mix of low growth and high inflation real assets, like energy and commodities, can be among the very few asset classes capable of providing positive real returns. Financial assets often just languish or fall.
A different playbook indeed.
And maybe a final thought to leave you with, tying back to that potential scramble crisis. Consider this. If the world's most vital energy choke point, the Strait of Hormuz, were to experience a prolonged soft closure, making passage prohibitively risky and expensive, how fundamentally would that reshape global alliances? How would it change the very notion of energy security, not just for nations, but for everyday life as we know it? What ripple effects would that have?
Something profound to think about. We encourage you to reflect on your own vulnerabilities, maybe explore the energy policies of your own countries or regions. How might a fundamental shift in global energy flows impact your daily life in ways you might not expect, far beyond just the price you pay at the pump?